Right, a very good warm morning and a happy Macro Monday to everyone. Hope everyone had a fantastic weekend and thank you for joining us today. There will be no actually caught report as Ole's got mandatory 2 weeks, I believe. He has to completely take away from the screens, keyboards, and everything, which will make it a little bit kind of quicker for going through today. So it'll be myself and, of course, the talented JK who will be taking up the charts. So let's get cracking. As always, solely views, opinions. These are not trading nor investment recommendations. Really highlights for me last week. Really, really amazing week, both from the new highs we continue to see in the likes of the euro up, another 169 basis points last week, and of course the Aussie dollar again, breaking up to new highs. I remember we were obviously pointing out how significant that close was 2 weeks ago, but amazing to just see that kind of follow through. So now going on for the 2 weeks, we basically have euro up 200 and about 30 basis points, and the Aussie up about 411 basis points, which is just amazing for G10 kind of currencies to be seeing those kind of moves. So we basically had a euro liftoff despite a very, very dovish Draghi. Watched the full press conference, the Q&A. There was very, very nothing hawkish at all that was coming from him. He was just bullish on the economy, but many, many instances saying still a lot of signs of no underlying inflation's feeding through. They stand ready to be more accommodative if needed, and they're going to wait until they see more signs of inflation. And also, they had not yet discussed QT from even a process perspective or even from a timeline perspective of when to actually bring it up. But again, sentiment in the near term is always, always key. And at the moment, the sentiment continues to be extremely, extremely bearish on the US dollar. So for me, again, last week was another classic week where it was a lot more about US dollar weakness, if you will, than let's say strengths and some of the other things. But on that same kind of sentiment theme, was same thing with RBA. I think the minutes were interpreted as a lot more hawkish than they actually kind of were, just given more of the technical factors and the momentum that were basically going on through kind of Aussie kind of crosses. On the BOJ, we saw a kind of a significant shift, not quite so hard in regards to them, let's say, lowering their inflation target from 2% to 1%, but they did ask for more time before hitting their CPI, which again to me is just lowering the bar and should obviously be bearish for dollar yen, bullish for yen, and that was one of kind of the few things that made sense, and this was significant kind of closes as we'll kind of get to later. The other thing I'll mention on the FX side was obviously the surprise cut from South Africa, making a few other of the higher yielding EM currencies that much sexier, and of course continue to kind of pull back on US 10s back below 225, Bunds back to that kind of key 50 point basis level, and again new lows being made on the VIX. Again, this here is all kind of a bit tongue-in-cheek. Of course, it's not different this time around, but it doesn't mean that we can't go lower before it all starts to unravel. Moving on to basically, this is kind of captures the week, the VIX. It's a multi-year chart since, of course, the GFC. And just to kind of give you context of what this 936 kind of level means, the 1230-ish level is, the 200-day kind of moving average on that. But you can just see how low we are, at least from a historical kind of basis. So kind of this week is really all about, from our perspective, obviously the Fed on Wednesday, early Thursday, Asia time. We do have U.S. GDP on Friday, which is key. And for out in Asia, and of course for anyone who plays Aussie crosses, Wednesday's got Australian kind of CPI. Now, it's also worth noticing that we'll hear from Banco de Brazil, where the market's expecting 100 basis point cut, Turkey, where nothing is being expected, and Russia, where even though the market's not expecting anything, there is still a bias towards cuts being there. From the Fed speaker camp, obviously post FOMC, first out the box will be cash carry, the lone wolf dissenter, if you will. There is also an OPEC meeting today, which I don't really have much color or kind of a view on. BOJ minutes, and I think importantly is going to be RBA's low speaking tomorrow. Actually, no, I believe that's Wednesday. That's also going to be quite important to see what comes through that, i.e. does he talk down the currency, or does he kind of let it slide, etc. And that's also some of the things that you should be waiting to watch out also from, let's say, the ECB camp, whether it's other people out there, government officials or ECB officials, without quoting kind of anybody. Obviously, being the last week of the month, it is also flash PMIs on the table, so watch out for that. And we will also have another, initial second quarter GDP reading for the first time out of the UK. That could also be kind of key. Now, again, with the Fed, normally this would be a copy paste kind of meeting, given that there's no press conference, but it is worth noting that they could be some potential signaling for a balance sheet reduction to start kicking off in September, right? So this is what most people are going to be looking for. I don't expect necessarily any kind of more dovish or any more kind of hawkish, let's say, Fed. I think this will kind of be just the next plan, if there is any delta, really to just, either they'll say September outright, or they'll say in the next meeting or the next kind of few meetings, just to kind of keep that optionality kind of open. There's, of course, a contingent out there, and of course, sentiment would probably be looking for more dovish Fed, just given how much the market wants a weaker U.S. dollar. But I don't expect that to go through, and them commenting on anything on CPI. So I don't expect any delta there. Now, in regards to some of the things that could potentially turn sentiment around for the U.S. dollar, it could be potentially a big beat on U.S. GDP. Perhaps even some of the flash PMIs, manufacturing and services, durable goods, could have a bit of a chance. But technically, and again, this is for me. Of course, JK will be giving his 2 cents. The 200 week is 92.20 in the DXY, and 91.91.9, if you recall, was that low that we made last year, basically. On the 6th of May, and then post that, the DXY went on a 13% kind of rampage. I'm not trying to say that this is going to happen this time around, but I will point out that this is definitely not something that the market expects to happen this time around. I don't think this market even expects a 3% rally in the DXY. So just kind of interesting to kind of see where we are, and it's kind of eerily similar because also during that time, everyone had also written off the dollar and the DXY, and it was all done and dusted. I am not so sure, right? And again, if it's nothing triggered this week in regards to kind of changing the sentiment in the near term for potential US dollar squeeze, hard to again know what it is. PCE on August 1st, Jackson Hole on the 24th, 22nd, or some kind of very big beat up in CPI, or actually waiting until the next kind of press conference and full court press, if you will. Fed meeting, which is going to be September 20th. Really, really hard for me to say right now. And a lot of people are asking this question, but I think a lot more people have just simply written it off and said, we're not getting more hikes from the Fed this year, or if we are, it's one and done, so it doesn't matter. That kind of same bias is going on, and I think Yellen has done just a terrific job of continuing to get the hikes in while keeping the U.S. dollar weak and keeping rates, low, right? So it's actually been even more accommodative as she's been hiking up higher, right? I think always interesting to keep in mind what seems to be the path of least resistance tactically in the market, and that for me is still lower rates over the next kind of few days to, let's say, 1 to 2 weeks, weaker U.S. dollar, lower vol, and of course this kind of also feeds into kind of high EM. On regards to kind of positioning, I still like silver and gold to the upside. We did hit the targets that we set out last week, if you recall, on Macro Monday. I do like yen's strength. I thought it was a very, very significant close on dollar yen on Friday. And as you know, weekly closes are quite strong, not only because we closed below the 100 and 200 day moving averages, but also the 100 and 200 weekly moving averages. And as I'm talking now, we're actually sub 111 on dollar yen. Euro crosses have risen much, much too fast and too far, in my humble opinion. We already kind of covered ECB, where, despite them being super dovish, it's continued to go up. I still don't think we've seen any kind of reversal signs. It'll be interesting to see what JK has on Euro kind of charts. But what I would be prepared for is getting ready for some downside to the Euro, whether it's, let's say, short Euro rubles, as well as also potentially some jump on trades where you have a short bias on, let's say, the Aussie given CPI kind of Wednesday, as well as Low looking to speak. I think it'd be hard pressed to see the people who've kind of profited this long not banking some of those profits, at least kind of protecting kind of the downside. The I think tough thing about, let's say, the euro and the Aussie is structurally they do look like they are going to go higher. Like I said, I still think that we are going to get to that 118.20, 120 level on euro dollar. Aussie looks like it definitely wants to go to 80 cents, and after that it could be kind of 84 cents. So just bear that in mind. This is more near-term kind of tactical, looking for an opportunity to kind of fade, catch a bit of the reversal. This is not kind of a medium to long-term kind of view. And again, very sometimes tricky to keep those two kind of opposing thoughts and positions in your mind. One last thing before I go over to the books, just a big picture thought. Quantitative easing was in theory supposed to be inflationary. It was supposed to cause companies to invest, people to go out and spend, and it actually ended up doing the opposite. Now, quantitative tapering is supposed to be, in theory, be deflationary, and it's supposed to cause companies not to invest. And I actually think that this is actually going to be in the opposite that is actually going to kind of occur. Because if you think about it, when rates are exceptionally low, you don't have to go out and build a capex or raise a plant. You can just turn around, borrow, and financial engineer your kind of earnings back up, because that's kind of your mandate, right? But again, I just think sometimes the unintended consequences of economic kind of theory. So it'll be very interesting to see what happens over obviously the next 6, 9, 12 to 18 months. So going on the books, there's no new positions on either. This is just kind of more thinking, which is pretty symmetrical across both books. Where potentially we'll be looking to add some long ruble and yen exposure, some short euro and Aussie exposure. Again, these could be some of the crosses, whether it's short euro ruble, short dollar ruble, short Aussie yen, Aussie Singapore dollar, which JK was saying was one of the technically weakest, or short euro yen, or short dollar yen. These are just kind of some of the thinkings that have been kind of having. It is worth noting, again, on Aussie, low speech plus CPI, and there has been, decent correlation between Aussie and New Zealand CPI, over the years. And of course, Kiwi data missed last week, 1.7 versus 1.9. Obviously, it's not a 1.1 correlation, but just something to bear in mind. And then again, also having a little bit of a rethink about cleaning up some of these kind of strategic positions, because a lot of these I just kind of wanted to get the book up and running. The strategic book was supposed to be a little bit more thematic, but there's definitely been some issues on some of the trades that I took. For instance, the puts, having that duration kind of bias is kind of hard, if not impossible, to really kind of trade around, as well as some of my financial kind of targets and so on just seem a little bit kind of lofty given where we are. So having a little bit of a rethink on that, and may revamp that quite heavily over the next 1 to 2, 3 weeks. And again, this is important, right? Where you go back, you take a look to go, do the themes still hold given the environment? Are there better themes out there, et cetera, et cetera, et cetera, right? And same thing kind of really on the tactical book. Again, thinking about the same kind of positions, and looking for a little bit more bigger bang for buck type of high kind of conviction trades, just given not only kind of the track record of the win ratios and this being all banked and crystallized, but also just kind of looking for just high kind of conviction type trades. With that, let me please pass it over to JK with the charts. Thank you so much.
Thank you, Kate. So starting off with the US dollar index, the USD once again punished all throughout last week. This is the weekly chart with the final 76.4% retracement level at 94.70 failing to hold its losses. The market is now left eyeing the 200 weekly moving average at 92.24, which, as Kay has mentioned, is the next downside target. Now this sits just above the 2016 all-time low at 91.88. The US dollar is approaching its multi-year final support 2015-2016 base that was formed. Now this remains as the final defense for the US dollar index. However, that 200 weekly moving average, again here at 92.24, should lend strong support in the week ahead. We set up a long trade slightly above here at 92.30 with a stop under 91.88, so stop below here. That's up just under a 0.5% move. To the top side, we're going to target the 95 handle, or just under 3% in gains. And it's becomes a similar story for the euro, which itself fast approaches the 200 weekly moving average as well. That sits at 118 handle. The euro last week closed at a decisive 2-year high. This week, the first level of topside interest is offered at this 2015 spike at 117.14. To the downside, buying should see weakness starting at the 116 handle. The weekly test for the euro is to print another settlement above the 115 handle here. As you can see, this was huge resistance throughout 15 and 16. A print of a settlement above 115 again will confirm and validate the bullish roadmap for the euro to then go on to test higher territories. Over to some commodity pairs, and starting off with the dollar CAD. The dollar CAD now remains a good 9% off its 2017 peak seen in May of this year. The dollar CAD continues to remain oversold and now targets the May 2016 low at 124.60 to lend the technical support it needs to arrest this aggressive slide. Therefore, we mark a tactical buy opportunity at just above that 2016 low at 124.60 with a stop at 124.10 or 50 pip stop. To the top side, we go on to target 126.60 around these levels here, or 200 points. That's the profit target there. The breakout in the Aussie dollar is confirmed as it claimed its second straight week of close above the 2016-2015 resistance levels. Our violent buying over our Aussie found selling just in front of the 80 handle last week at 79.87, which was also just below the 200 weekly moving average. Now we continue on this week with quite a bit of a positive bias over the Aussie. We would treat any retracement as a strong opportunity to explore some long positions. We mark support at 77.77 as the level to hold losses for the Aussie, followed by 77.27. And as long as these zones can hold, the Aussie should have its next attempt at the 80 handle. As we all know, retesting breakouts and for prices to hold at these breakout levels can be a very powerful signal, and this is the scenario we explore for our Aussie in the week ahead. Our target of 126.10 came in over the US 10-year bonds, with the bond price now comfortably sitting above the 200 daily moving average, which was successfully claimed last week. Any losses over the US 10 years is expected to hold at 126.01, this level here, and the next topside target is marked at 126.21. So those falling US bond yields coupled with the double top curse saw the dollar yen fail to hold its 50% retracement between the June low to the July high, as well as failing to hold the 200 daily moving average. The weekly chart shows that the dollar yen closed with its nose right on the 200 weekly moving average. Last week we mentioned the bearish bias over the dollar yen, as well as the failure for the pair to maintain trade above the 200 weekly to provoke further weakness, leaving the pair vulnerable down to the 110 handle. Now, early Asia trade this morning sees the dollar yen below the 200 weekly moving average. It's a critical week ahead, as the market will be watching whether any rallies can hold above the 200 weekly, with preferred topside test to claim the 112 handle, or where the current 200 DMA currently sits. Covering off some pairs across ruble, as Kay was presenting on earlier in this section. We're looking at strength in the ruble to start emerging. This is the daily chart of the euro ruble, with last week's high coming in at some challenging levels as seen in history. But more interesting is that the euro ruble bottomed out in 2017 as it formed then a reversal pattern. You can argue that this is a inverse head and shoulder formation, and the high we saw last week coincidentally happened to be a 100% inverse head and shoulder target. Now, if this level happens to hold another attempt of gains this week, we would expect profit taking to drive the pair lower over the coming sessions. The USD ruble last week found rejection at the 2015 significant low, as I've marked here on the chart, and selling drove the pair down to close below the 200 DMA. Note that prices have extended back to important support levels as are marked here on the chart. Now, this should define whether a deeper corrective phase is developing. Now, a break of the last week's low at 58.75 is necessary to reassert the next downside buy, so all eyes on this trend line here. Our Aussie index continues to maintain trade above the base that is formed from May of this year. Last week we saw a brief dip to the 200 DMA. This defended losses for our ASX stocks. The highlighted zones here will continue to lend buying opportunities. However, a breach and close of the 200 DMA, which is what we are seeing currently here in early Asia trade, this will threaten further losses ahead. We would like to see a breach of 57.92 on a rally. However, this level just below 58 handle is expected to be tough resistance. Over to the Nikkei, the technical reading over the Japanese index, it remains unchanged for 3 weeks now. The Nikkei continues to consolidate close to the 2015 highs, whilst buying power continues to lose momentum, as evidenced by the declining RSI. The pins seen in these past 4 weeks, the lower highs is not encouraging for Nikkei bulls, with last week's close at its lows with a red bar signals further losses ahead for the Japanese index unless that dollar yen can turn around. The E-mini reached our target at 24.72 or the 261.8 Fibo extension of this March to April range. Above last week's high, we have the same levels of resistance to mark as we offered in last week's presentation, 24.80, finally 24.94, losses to find support at 24.59 followed by 24.50. WTI crude had one attempt last week in claiming this resistance level here. However, it failed to settle above 47 handle, and this translated into technical weakness, and this subsequently led crude to eliminate all the gains that were built throughout the week. Downside support to hold losses will be offered by this short-term June-July trend line, and key test remains for WTI to claim this 38.2% retracement between the 2017 January high down to the lows for the week ahead. Again, only a break above this level is necessary to argue for a short-term bullish shift. Lastly, gold continued to catch a decent bid last week. Buying drove it back above the original January, March, May support trend line, although it was threatening to trade back below it, but we saw buyers sitting just below the trend line here. Short-term setup, we do see continued gains in the week ahead. Upside target starts at 12.67, above here at 12.86. Any pullbacks is expected to see gold find support at 12.45, and below here, once again, the January, March, May support trend line should hold losses for gold. That's pretty much it for the charts and the week ahead. Back over to Kay.
All right, thanks so much for that, JK. Some of you may want to just check out the replay because we seem to have a little bit of a lag on when the slides are actually popping up. So apologies for that. Not quite sure why that's kind of come up. Obviously, a lot on. Highly recommend you check out the replay. It's of course all about FOMC statement that's going to be coming out on Wednesday. Of course, second quarter GDP on the U.S. is very key on Friday. It is a flash PMI week. We do also have Aussie CPI on Wednesday, as well as RBA's low set out to speak. And as JK has eloquently shown on the charts, there's a lot of key closers going on from US 10 to where bunds are, to where oil is, to the likes of the euro and the Aussie. And positioning wise, we kind of favor tactically, potentially trying to catch a euro and Aussie reversal, but also being very, very much aware that structurally the next kind of move is definitely for those to kind of go much, much higher. So something to kind of bear in mind. I still think yields will be kind of coming off over the next kind of few days to a few weeks. And of course, let's see whether the Fed will give indication that they're looking towards starting their balance sheet reduction in September. Wishing everyone a fantastic day and a brilliant week up ahead. Thanks so much.